From groceries to home goods, according to the latest inflation report, you're probably feeling the pinch. Released just hours ago, the Consumer Price Index shows prices climbed again in September, though not by much. 5 on your side's Keely Arthur is at the Food Lion on Lake Wheeler Road. Keely, break down what these numbers really mean for home budgets and why the Fed's next move could depend on data it doesn't have.
Right, Renee, you know I've been covering these monthly reports for years now. And what's interesting about this report is it came out 10 days late. That's, of course, because of the government shutdown. I want to explain exactly what the CPI report is. It is basically retroactive. So we're not talking about inflation for this month, October. We're talking about inflation last month, September. That's because people have to gather what prices were in the month and then put it all together. I say all that because that means the data was out there and likely gathered before the government shutdown. There's been a lot of concern about the validity of this report, and I've spoken to several economists who looked at the report today and said there was really nothing different in terms of the way things were gathered compared to August and previous months. So you can trust the report. It is showing that inflation is 3% higher for this September than it was last September. So let's break it all down. Talk first about grocery store prices. Some good news, shockingly, on the egg front. We know that egg prices have been rising and rising for years. It's actually down a little bit right now, which is just incredible. We are seeing increases, though, in other things like beef and orange juice. So, you know, those grocery staples, kind of a mixed bag there. The CPI tracks all sorts of items, though, things like energy prices, cars, all of it. And then economists look at that data along with the jobs report to kind of suss out where the economy is headed. The issue with that is, though, we don't have the jobs report. That is because of the government shutdown. So today I asked a economist I've spoken to many times to look into his crystal ball and tell me what he thinks is going to happen regarding a potential recession.
The current set of policies are increasing the risk of a recession, and that's what concerns me. Because the economy was on a has looked very healthy and had, job creation continued to exceed expectations every month. People, the general community, including myself, was saying, okay, that we're creating a lot of jobs, even more than demographics suggests, and so we're kind of running out of people, and now the almost the opposite has happened, where we're creating very few jobs now, and that's worrying. And
Cohen and other economists point to ever-changing tariff policies. We saw that happen overnight with Canada and a crackdown on immigration as major factors creating the uncertainty. So on the tariff front, companies are trying to respond to all the changes. So they may be hiring less as a result just because they don't know what's going to happen next. And then, of course, immigration affects jobs. We are already seeing the workforce, for example, in construction start to shrink. So what does this mean for interest rates? The Fed takes the CPI report, the jobs report, and they look at that and they go, should we raise interest rates or lower them? Everyone wants them lower because that will help drive things like your credit card interest rates and potentially mortgage rates down. It remains to be seen what's going to happen, but a lot of people predicting that we are going to see another federal rate cut, which is good news. Coming up in the later shows, I'm going to explain to you what you can do to weather the storm if you're just trying to put food on the table, and also what you can do if you're heavily invested in the stock market. So something for everybody. Reporting live in Raleigh, Keely Arthur, 5 on your side.